The market was wrong, Wall Street was too naive, and the accounts of investors who are getting ahead of themselves are facing the risk of evaporating. Welcome to the In-Depth Market Navigator today. We need to talk seriously about what just happened last night. When everyone from speculative hedge funds to housewives trying their hand at stocks believed that the Federal Reserve or Fed was done, that interest rates would drop, and the era of cheap money was about to return, the United States economic data slapped that drunken crowd straight in the face. The United States dollar, or USD, has come back to life. It is not just recovering, it is growling back like a monster waking up from hibernation. And the reason for this resurgence lies in a tiny number, but one with destructive power, 191,000. That is the number of initial jobless claims. What was the expert forecast? Much higher than that. The market wanted to see this number rise. Why? Because bad economic news is good news for stocks. Only when the economy weakens does the Fed have a reason to pump money and cut interest rates. But no, the number dropped to 191,000, a record low in many months. What does this mean? It means the United States labor market is not cooling down as we thought. Companies are not laying off employees. Workers still have jobs, still have income, and are still spending. The United States economic machine is still running too hot. And to the Fed, hot means dangerous. Put yourself in the shoes of Jerome Powell and the FOMC members right now. What is their mission? It is to destroy inflation. Where does inflation come from? From rising wages and strong spending. If the labor market remains tight as the 191,000 data just indicated, upward pressure on wages will remain. If wages rise, inflation cannot return to the 2% target. So, what excuse does the Fed have to cut interest rates in the upcoming meeting? The market has jumped the gun. Investors have priced in interest rate cuts too early. They bought stocks, bought bonds, and bought Bitcoin with the blind belief that the Fed would rescue them. But last night's data is a brutal reminder. The Fed is not your friend. The Fed is a friend of price stability. If the Fed looks at this data and says the economy is still too strong, we need to keep interest rates higher for longer to ensure inflation is dead. Then what? At that point, the entire pivot scenario will collapse. This is when the risk of correction becomes more real than ever. When expectations are shattered, disappointment will turn into selling pressure. Those who are using margin or leverage to catch the bottom in the past few weeks may be the first to face a margin call. Look at the DXY index, or US dollar index, in intermarket analysis. DXY is gravity. When gravity increases, everything else is pulled down. When employment data is better than expected, United States Treasury yields immediately bounce up. The 10-year bond yield, the measure of global capital cost, is threatening to break old peaks. When United States yields rise, what will global money do? It will withdraw from risky markets, withdraw from emerging markets, withdraw from gold, to flow back to shelter in the USD and United States bonds, to enjoy safe high interest rates. The strengthening of the USD is a Terminator for the profits of United States multinational corporations due to exchange rate losses. It is also a nightmare for commodity prices like oil, gold, and copper, and especially it is a sworn enemy of risk assets like crypto. We are seeing DXY forming extremely strong bullish reversal candlestick patterns on the daily frame. If DXY surpasses the psychological resistance level of 104 or 105, we will witness a widespread margin call on non-dollar assets. The most dangerous thing right now is not the number 191,000 itself, but the positioning of the market. Throughout the past month, the Fear and Greed Index has touched the threshold of extreme greed. Retail capital has poured into the market frantically for fear of missing the year-end bull train. When everyone is standing on one side of the boat or long, just a small wave of bad news is enough to capsize the boat. The employment data last night was that wave. It sows doubt. Am I wrong? Will interest rates really drop? Once doubt creeps into the investor's mind, their next action is not analysis but pressing the sell button. We call this a bull trap. The market pulls up to lure new money and creating the illusion of a new uptrend, then suddenly turns around when macro news does not support it. Those who chased buys at the recent short-term peak are on the chopping block. All eyes are now on the upcoming Federal Open Market Committee, or FOMC, meeting. Based on this latest data, we can draw two main scenarios. Scenario 1, the hawkish pause. Probability 70%. The Fed will keep interest rates unchanged, not raising, not lowering. But in the press conference speech, Chairman Powell will be extremely tough. He will emphasize the overheating labor market, citing this 191,000 figure, and affirm that it is too early to think about cutting interest rates. He will extinguish all hopes of monetary easing in the first half of next year. Consequent stocks, especially the technology group, will drop sharply due to revaluation. USD skyrockets. Gold plunges. Scenario 2. The dovish surprise probability 30%. The Fed ignores employment data, focuses on core inflation indicators, or core PCE, which are decreasing, and sends a soft signal. Consequence. This would be a classic short squeeze. The market will explode, breaking old peaks in amazement. But remember, with employment data, this scenario is very unlikely because it would cost the Fed its credibility in the fight against inflation. The Fed is extremely afraid of the mistakes of the 70s, specifically of Arthur Burns, when easing too early caused inflation to return and devastate the economy. Therefore, their natural tendency right now is better to kill by mistake, keeping rates high, than to let it slip. So, what should individual investors do between these pincers? I repeat the classic maxim, do not fight the Fed. If the Fed signals toughness, do not try to rush into buying stocks just because they look cheap. Do not be ashamed to hold cash right now. Cash is an investment position. It gives you the option to buy cheap assets when the market crashes. In the context of short-term interest rates, still at 5%, holding cash is not bad at all. If you are using leverage, lower it immediately. Upcoming volatility will be very large. Stop hunt sweeps with an amplitude of 5% to 10% in a session are completely possible. Do not let your account burn before the trend is clear. If you still want to be in the market shift, cash flow from hot growth stocks or tech to value stocks in essential sectors like consumer staples, healthcare, or energy. These groups are less sensitive to interest rates and usually hold value well when the market corrects. Although gold is good in the long term, in the short term, pressure from the USD is huge. Do not catch a falling knife. Wait for price reaction at hard support zones. If the USD continues to break peaks, gold may retest much lower price zones. That is the time to buy, not now. Ladies and gentlemen, the event of jobless claims dropping to 191,000 is an expensive lesson in humility before the market. No one, including top Wall Street experts, has a crystal ball to know exactly where the economy is going. We are living in a data-dependent period. Every economic number released makes the market jump. Do not bet your entire fortune on a single scenario that interest rates will drop. Always have a defensive scenario for the opposite situation. The USD is coming back to life, and when the king returns to the throne, the courtiers' risk assets must know how to bow. Do not try to be a hero catching the bottom today, only to become a martyr tomorrow. Be patient. Wait for the FOMC meeting. Wait for Powell's official statement. Right now, wait and see is the wisest action. Profit is not for the clumsy and hasty, but for those who know how to ambush at the right time. I am Market Navigator. I wish you a steady hand on the oars before the coming rough waves.